There is one number in the global markets today that investors around the world are watching very closely, and that number is $100 oil. For months, energy prices had been slowly stabilizing, giving markets hope that inflation pressures were finally cooling and that central banks might soon gain the flexibility to support economic growth again. But over the last few days, something changed. Oil prices suddenly surged again as tensions in the Gulf region intensified, pushing traders to reassess the risks to global energy supply. At the same time, stock markets in several parts of the world began showing signs of stress. Safe haven assets like gold started moving higher, and currencies began shifting as investors searched for safety. When multiple markets begin reacting at the same time, experienced investors know it usually means something larger is unfolding beneath the surface. Right now, global financial markets are responding to a combination of geopolitical tension and economic uncertainty that could shape the direction of the world economy over the coming months. The situation in the Gulf has quickly become one of the most important drivers of market sentiment because that region sits at the center of the global energy system. A large portion of the world's oil shipments move through critical shipping lanes in the Middle East. When tensions rise there, traders immediately begin calculating the possibility of supply disruptions. Even a small risk to those routes can cause energy prices to move sharply because the global economy still depends heavily on stable oil flows. As the price of oil started climbing again, the reaction spread across multiple financial markets. In Asia, several stock exchanges showed early signs of volatility as investors reacted to the possibility of higher energy costs. Countries that depend heavily on imported oil often feel the pressure first. Higher fuel prices increase transportation costs, raise manufacturing expenses, and squeeze profit margins for businesses that rely on global trade. This is why markets in export-focused economies often react quickly when energy prices surge. At the same time, European markets began responding as investors tried to assess what higher oil prices could mean for inflation and economic growth. Europe has already spent several years navigating energy disruptions and inflation shocks. Another sudden rise in energy costs could complicate the fragile recovery that many economies are trying to maintain. As a result, several major European stock indices saw investors moving cautiously, with sectors tied to transportation and manufacturing facing renewed pressure. In the United States, the reaction was more complicated. On the surface, American stock markets initially appeared relatively stable compared with other regions. Large technology companies continued to attract investor interest, and some market participants still believed that the United States could remain insulated from global shocks. However, beneath the surface, financial professionals were watching several indicators very carefully. One of the most important was the bond market. U.S. Treasury yields began showing signs of volatility as investors considered what rising energy prices might mean for inflation expectations. If oil remains elevated, it can quickly feed into consumer prices through transportation, electricity generation, and industrial production. Central banks, including the Federal Reserve, have spent years trying to control inflation through higher interest rates. If energy prices begin pushing inflation higher again, it could delay any plans to reduce borrowing costs. This is where the situation becomes particularly important for global markets. Higher interest rates do not just affect government bonds. They influence the valuation of stocks, especially technology companies and other sectors that depend on long-term growth expectations. When borrowing costs rise, investors begin discounting future profits more heavily. That process can lead to sudden changes in how markets price certain companies. While equity markets were adjusting to the news, precious metals began attracting attention again. Gold prices started moving higher as investors looked for assets that tend to perform well during periods of uncertainty. Gold has long been considered a financial refuge during geopolitical tensions because it does not depend on the stability of any single currency or government. When confidence in financial systems weakens, gold often becomes one of the first places investors look. Silver also began gaining momentum alongside gold, although silver's role in the market is more complex. Unlike gold, silver has both monetary and industrial demand. It is widely used in electronics, solar technology, and advanced manufacturing. That means silver prices are influenced not only by investor sentiment, but also by expectations about global economic activity. When both gold and silver begin rising together during geopolitical tension, it can signal that investors are preparing for a period of uncertainty that could affect both financial markets and industrial production. Meanwhile, the currency markets were reacting in their own way. The U.S. dollar initially strengthened as investors moved toward assets traditionally seen as safe during global instability. This pattern has repeated many times in modern financial history. During times of uncertainty, global investors often move capital into U.S. Treasury bonds and dollar-denominated assets because they are considered relatively secure and liquid. However, currency movements during geopolitical stress can sometimes send mixed signals. A stronger dollar can indicate investor confidence in U.S. financial markets, but it can also reflect global stress that forces institutions to hold more dollars to meet financial obligations. Many international loans and trade contracts are denominated in dollars, which means that during times of volatility, global demand for the currency can increase rapidly. Energy markets remained the center of attention throughout the day. Oil traders closely watched shipping activity, insurance rates for cargo vessels, and official statements from governments involved in the conflict. Even small changes in shipping conditions can affect global supply chains. If tanker routes become more expensive or risky to operate, the cost of transporting oil rises, and those higher costs eventually reach consumers and businesses around the world. Natural gas markets also began responding to the situation. Several regions rely heavily on imported energy to support their industrial sectors and power generation systems. Any threat to energy supply can trigger sudden movements in gas prices, particularly in Europe and parts of Asia. Higher natural gas prices can raise electricity costs, which then affects factories, transportation networks, and household spending. All of these market reactions are connected. Rising energy prices increase inflation risks. Inflation influences interest rate decisions. Interest rates affect stock valuations. Currency movements influence global trade and capital flows. When geopolitical tensions disrupt one part of the system, the effects can spread quickly across multiple markets. Investors are now asking an important question. Is this simply a temporary geopolitical shock, or could it signal a deeper shift in how global markets operate? The reason this question matters is because the modern financial system depends heavily on stability in a few key areas. Stable energy supplies keep industrial economies running smoothly. Predictable shipping routes support global trade. Reliable financial flows allow governments and businesses to borrow money at manageable costs. When any of these pillars becomes uncertain, investors begin adjusting their expectations for the future. For years, many market participants believed that the global economy had entered a relatively stable period. Even when conflicts or economic disruptions occurred, central banks often responded with policies that helped financial markets recover quickly. But the current situation is testing that assumption. The world is now dealing with several pressures at once, including geopolitical tension, high government debt levels, lingering inflation concerns, and shifting global alliances. This combination is forcing investors to reassess how resilient the financial system really is. Markets that once appeared calm can suddenly become volatile when multiple risks begin interacting with each other. That is why traders and institutions are now closely monitoring not just energy prices, but also bond markets, currency movements, and the behavior of safe haven assets. Right now, the most important factor remains the energy market. If oil prices stabilize, financial markets may gradually return to a more predictable pattern. But if tensions continue escalating and energy costs remain elevated, the ripple effects could spread further across the global economy. This leads to the central question that investors everywhere are now trying to answer. Is the current market reaction simply the beginning of a short-term adjustment, or could it be the early stage of a much larger shift in global financial conditions? That question is exactly what we will explore next. To understand why markets are reacting so strongly right now, it is important to look beyond the headlines and examine the deeper financial structure that connects energy, inflation, capital flows, and global investment behavior. What we are seeing in the markets today is not just a reaction to geopolitical tension. It is a reminder of how tightly the modern financial system is connected to the flow of energy and the movement of capital around the world. For decades, the global economy has been built on a relatively stable arrangement. Energy-producing nations sell oil and gas to the rest of the world, and the revenue generated from those sales often returns to global financial markets. A large portion of that capital eventually finds its way into government bonds, stock markets, real estate investments, and infrastructure projects. This continuous recycling of capital has quietly supported financial markets for many years. Energy prices play a central role in this system because they influence almost every part of the global economy. When oil prices are stable and predictable, businesses can plan investments with confidence. Transportation costs remain manageable, manufacturing stays efficient, and consumers are able to spend more on goods and services rather than on fuel. In that environment, economic growth tends to remain steady. But when energy prices suddenly rise or become unpredictable, the entire financial structure begins adjusting. Higher fuel costs increase the price of transporting goods across oceans and continents. Airlines face higher operating expenses, shipping companies pay more for fuel, and manufacturers see production costs increase. Those higher costs eventually reach consumers through rising prices on everyday products. This process is one of the main reasons inflation often follows major energy shocks. Energy is not just another commodity, it is a fundamental input for almost every sector of the economy. When the cost of energy rises, it spreads through supply chains and affects everything from food production to industrial manufacturing. Central banks pay very close attention to this dynamic. Institutions like the Federal Reserve, the European Central Bank, and other major monetary authorities have spent the last several years trying to bring inflation under control after the sharp price increases that followed the pandemic. They raised interest rates aggressively in order to slow spending and reduce inflationary pressure. Higher interest rates have already changed the behavior of financial markets. Borrowing has become more expensive for businesses and consumers. Mortgage rates increased, making housing purchases more difficult in many regions. Companies that rely heavily on debt have faced higher financing costs. All of these factors were part of the strategy to cool inflation. However, if energy prices rise again while interest rates remain elevated, central banks could find themselves in a difficult position. On one hand, rising energy costs would push inflation higher again. On the other hand, keeping interest rates too high for too long could slow economic growth significantly. This tension between controlling inflation and protecting growth is one of the most delicate challenges in modern monetary policy. The energy situation we are seeing now is forcing investors to think about this problem once again. Markets are beginning to consider whether the inflation battle is truly over or whether another wave of price pressure could be forming. At the same time, institutional investors are closely watching the movement of global capital. When uncertainty rises, large financial institutions often adjust their portfolios in order to reduce risk. That can mean shifting money away from assets that depend heavily on economic growth and toward assets that historically perform better during uncertainty. This is one reason precious metals often gain attention during geopolitical stress. Gold, in particular, has a long history as a store of value during periods when investors question the stability of currencies or financial systems. When uncertainty increases, demand for gold often rises as investors look for a form of wealth that exists outside the banking system. Silver can also benefit from this shift in sentiment, although it behaves somewhat differently from gold. Because silver is widely used in technology, solar panels, electronics, and other industrial applications, its price reflects both financial demand and expectations about industrial activity. When silver begins rising alongside gold, it sometimes signals that investors are preparing for both financial uncertainty and long-term structural demand for metals tied to modern technology. Another factor influencing market behavior right now is the movement of institutional money. Large pension funds, sovereign wealth funds, and asset managers control enormous pools of capital. These institutions often rebalance their portfolios when economic conditions change. Even small shifts in their investment strategies can influence global markets because of the sheer size of their assets. If geopolitical risk continues increasing, institutions may begin allocating more capital towards sectors considered resilient during inflation or energy shocks. These can include energy companies, commodity producers, and certain types of infrastructure investments. At the same time, sectors that rely heavily on cheap borrowing and long-term growth expectations could face more scrutiny. Technology companies, for example, have benefited from years of low interest rates and abundant liquidity. Investors were willing to pay high valuations because borrowing costs were low and future profits were discounted less heavily. But in an environment where interest rates remain elevated and global risks increase, investors sometimes begin questioning those valuations. That does not mean technology companies suddenly lose their importance in the economy. Many of them remain extremely profitable and continue driving innovation. But when financial conditions tighten, markets often become more selective. Investors start focusing more on balance sheets, cash flow, and realistic growth expectations rather than simply rewarding future potential. All of these structural factors are now shaping how markets interpret the current geopolitical situation. Investors are not only reacting to headlines, they are thinking about how energy prices, inflation pressures, interest rates, and capital flows might interact over the coming months. From this perspective, two broad scenarios are beginning to emerge in financial discussions. The first scenario is the more optimistic one. In this outcome, the geopolitical tensions in the Gulf remain contained and do not escalate into a larger regional conflict. Shipping lanes continue operating normally, energy supplies remain stable, and oil prices eventually stabilize after the initial surge. If that happens, financial markets may gradually regain confidence. Investors would likely shift their focus back toward economic growth, technological innovation, and corporate earnings. Central banks might eventually gain enough confidence that inflation pressures are easing, allowing them to slowly adjust interest rate policies in a way that supports economic stability. In that environment, stock markets could recover from the initial volatility. Technology companies might continue leading market performance, while commodities and precious metals settle into more moderate price ranges after their temporary surge. However, the second scenario is more complicated and carries greater uncertainty. In this scenario, tensions in the Gulf continue rising, creating sustained pressure on energy markets. Oil prices remain elevated for an extended period, increasing transportation costs and production expenses across the global economy. Higher energy prices would make it more difficult for central banks to declare victory over inflation. If inflation begins rising again, monetary authorities could feel forced to keep interest rates higher for longer than investors currently expect. That would create additional pressure on debt-heavy sectors and could slow economic growth in several major regions. Under those conditions, financial markets might experience more volatility as investors reassess the outlook for growth and interest rates. Sectors tied to energy production and commodities could attract increased attention, while sectors that depend heavily on cheap financing might face more cautious investment. Precious metals could also benefit from this environment because prolonged uncertainty often increases demand for financial assets that serve as long-term stores of value. Gold and silver have historically performed well during periods when investors become uncertain about inflation, currency stability, or geopolitical risk. Both of these scenarios remain possible, and financial markets are currently trying to determine which one is more likely. Markets do not wait for certainty. They constantly adjust prices based on probabilities and expectations. This is why investors around the world are now focusing on one key factor that could determine which scenario becomes reality. That factor is energy stability. If global energy supply remains stable and tensions begin easing, markets may eventually move past the current volatility. But if energy supply becomes more uncertain and prices remain elevated, the ripple effects could spread through inflation, interest rates, and investment flows across the entire global economy. Right now, that is the central question shaping financial markets. Right now, investors around the world are watching a few critical signals that could determine where global markets move next. When uncertainty spreads through the financial system, markets begin focusing on a small number of indicators that reveal whether the situation is stabilizing or becoming more dangerous. At this moment, the most important signals are coming from energy markets, central bank policy expectations, geopolitical developments, and the behavior of key financial assets like gold, silver, the US dollar, and global stock markets. Energy prices remain the first and fastest signal in this story. Oil has always played a central role in the global economy because it influences transportation, manufacturing, agriculture, and electricity generation. When oil prices move sharply, the effects spread quickly across supply chains and consumer prices. That is why traders, economists, and policymakers are watching oil markets almost hour by hour. If oil prices begin stabilizing over the coming weeks, that would suggest that energy supply routes remain secure and that geopolitical tensions are not disrupting production or transportation in a meaningful way. In that case, inflation pressures might remain manageable, allowing central banks to continue gradually moving toward a more balanced monetary policy. Markets tend to respond positively when energy prices stabilize because it restores predictability for businesses and consumers. However, if oil prices continue rising or remain elevated for a long period, the situation becomes more complicated. Persistent high energy prices can act like a tax on the global economy. Businesses must spend more on fuel and logistics, households spend more on transportation and heating, and governments may face pressure to support consumers through subsidies or other programs. These pressures can slow economic growth while simultaneously pushing inflation higher. That combination is one of the most difficult environments for central banks to manage. Monetary authorities prefer conditions where inflation and economic growth move in opposite directions. But when both inflation and economic stress rise together, policymakers must choose which problem to prioritize. This is why central bank decisions will be one of the most closely watched developments in the coming months. The Federal Reserve, the European Central Bank, and other major monetary institutions will likely analyze every data point related to inflation, employment, and energy costs. Their decisions on interest rates influence everything from mortgage payments to corporate investment decisions. If policymakers believe inflation risks are rising again, they may feel forced to keep interest rates elevated longer than investors currently expect. On the other hand, if economic growth weakens significantly, central banks could eventually shift toward policies that support financial stability and economic recovery. At the same time, geopolitical developments will continue shaping market expectations. Financial markets do not respond only to economic data. They also react to political events, diplomatic negotiations, and security developments that could affect trade routes or energy production. Even small changes in geopolitical risk can move markets because investors constantly try to anticipate the future rather than react after events have already occurred. Shipping routes in the Gulf remain particularly important. A significant portion of global oil shipments passes through narrow maritime passages that connect energy-producing regions with major consuming economies. If shipping traffic remains steady and insurance costs for cargo vessels remain stable, markets may gradually regain confidence that energy supplies will continue flowing normally. But if shipping costs rise sharply or insurance companies begin charging higher premiums for vessels traveling through the region, it could signal growing risk to global supply chains. Currency markets will also provide important clues about how investors view the situation. The US dollar typically strengthens during periods of global uncertainty because investors see it as a stable and liquid reserve currency. However, the meaning of a stronger dollar can vary depending on the broader economic context. Sometimes it reflects confidence in the US economy. Other times it reflects global stress that forces institutions to hold more dollars in order to manage financial obligations. If the dollar continues strengthening while global markets remain volatile, it could indicate that investors are seeking safety and liquidity. That type of movement often occurs during periods of financial tension. On the other hand, if the dollar stabilizes while global growth expectations improve, it could signal that investors believe the economic environment is becoming more balanced. Precious metals will also play an important role in revealing investor sentiment. Gold has historically acted as a financial refuge during periods when confidence in currencies or financial systems becomes uncertain. When geopolitical tensions rise and inflation risks increase, gold often attracts attention as a store of value that exists outside the traditional banking system. Silver may become particularly interesting in this environment because it sits at the intersection of monetary demand and industrial demand. The global economy is undergoing a major technological transformation involving renewable energy systems, electric vehicles, and advanced electronics. Many of these technologies require significant amounts of silver in their production processes. That means silver demand is influenced not only by financial markets, but also by long-term industrial trends. If silver prices begin rising alongside gold during a period of geopolitical tension, it can signal that investors are considering both financial risk and structural demand for metals used in modern technology. Some investors view silver as a metal that can benefit from both monetary uncertainty and industrial growth, although it is often more volatile than gold. Stock markets will also provide critical signals about how investors interpret the broader economic outlook. If global equity markets stabilize and begin recovering after the initial volatility, it could suggest that investors believe the geopolitical situation will remain contained and that the global economy will continue expanding. However, if stock markets begin experiencing deeper or more prolonged declines, it could indicate that investors are becoming concerned about slower economic growth, higher interest rates, or persistent geopolitical risk. Market corrections often occur when investors collectively reassess their expectations about the future. Technology stocks in particular will be closely watched because they represent a significant portion of global market valuations. Over the past decade, technology companies have driven much of the growth in major stock indices. Their performance often reflects investor confidence in long-term economic expansion and innovation. But technology companies are also sensitive to interest rates because many of them rely on future growth expectations. When borrowing costs rise or economic uncertainty increases, investors sometimes reevaluate the price they are willing to pay for future earnings. This is why technology stocks often respond quickly to changes in interest rate expectations. Another area investors are watching is the broader commodity sector. Energy companies, mining companies, and resource producers often perform differently from other sectors during periods of inflation or supply disruptions. If energy prices remain elevated and global demand for raw materials continues growing, resource-producing companies could attract more investment attention. This is one reason discussions about real assets have become more common in financial circles. Real assets include commodities, natural resources, and infrastructure that provide essential goods and services to the global economy. In environments where inflation risk and geopolitical uncertainty increase, some investors prefer holding assets that represent physical resources rather than purely financial claims. All of these factors will shape how the global economy evolves over the coming months. Markets rarely move in straight lines. Instead, they respond to a continuous flow of information about economic data, political developments, and investor sentiment. What makes the current moment particularly important is that multiple forces are interacting at the same time. Energy markets are responding to geopolitical tension. Central banks are still navigating the aftermath of the largest inflation shock in decades. Governments are managing high levels of public debt. Meanwhile, technological transformation and shifting global alliances are changing the structure of the international economy. These forces are creating a complex environment in which investors must think carefully about risk, opportunity, and long-term trends. Some sectors of the market may experience volatility, while others may benefit from the structural changes taking place in energy, technology, and global trade. Ultimately, financial markets are constantly adapting to new information. What appears uncertain today can become clearer as events unfold. Investors, policymakers, and businesses are all trying to interpret the signals coming from energy markets, central bank decisions, and geopolitical developments. The key takeaway from this moment is that global markets are entering a period where stability cannot be taken for granted. The systems that support global trade, financial flows, and economic growth depend on cooperation, reliable supply chains, and predictable policy decisions. When those systems face pressure, markets adjust quickly. For investors, that means paying close attention not only to market prices, but also to the underlying forces shaping those prices. Energy stability, inflation trends, central bank policies, and geopolitical developments will continue influencing financial markets long after the immediate headlines fade. What happens next will depend on how these forces interact. If tensions ease and energy markets stabilize, the global economy may continue growing despite temporary volatility. But if geopolitical risks persist and energy costs remain elevated, markets could face a longer period of adjustment. Either way, the events unfolding right now are reminding investors of something fundamental about financial markets. The global economy is deeply interconnected, and when one part of the system begins to shift, the effects can travel much farther than many people expect.